managers here at BackNine Insurance. I want to thank everyone for joining us today and taking a few minutes out of your busy day to listen to what we have to say. I want you to know that this is a big deal. Life insurance with the long-term care riders is something we're having a lot of success with. We're doing very well with it. I'm going to show you today why we're doing so well with it. The great part about it is it's not a hard conversation to have. It's not a tough concept to explain. We actually designed a case about a month ago, actually, for a brother and a sister in their mid-20s, actually, and Dad wanted to add the LTC rider because he knew that premiums would be locked in at the rate of a healthy 25-year-old. So no client is too young for this concept. In fact, there's also a way here now through a carrier, and you guys can call me after the webinar for details, where we can actually get you the LTC rider for free. So let's begin. Let me do some quick legal disclosures here to abide by our compliance department, and let's begin. So today we are going to discuss what is the need for long-term care. We're going to discuss paying for long-term care insurance and different ways to go about it. And lastly, we're going to discuss life insurance with a long-term care rider. So before we get started, let's go over some facts I hope you find interesting. I know I did. So at least 70% of people over the age of 65 will require long-term care services at some point in their lives. 78 million baby boomers will retire over the next 2 decades. 1 year of full-time care, as of today, averages $94,000. And by the way, these are figures we've pulled from the 2013 Cost of Care survey by John Hancock. And lastly, in 20 years, the cost of 1 year of nursing facility care is expected to increase to $191,500. I want you to think about it. Look at those numbers and let them digest. The next 20 years are going to be the most important of your career. How important? They could turn your 6-figure career into a 7-figure income career. Trust me, we know. We've already sent agents 7-figure commission checks. It is already happening. Baby boomers are going to retire. Not only does this mean that 78 million of them will need help transition into retirement, this also means that $30 trillion of wealth are going to be transferred to their heirs over the next 20 years. What would happen if baby boomers had to dip into or even sell off their assets to pay for long-term care costs? There goes all that wealth. On a side note, not pertaining to today's webinar, but with the fact that baby boomers are retiring over the next 20 years, this creates a tremendous opportunity to write a lot of annuity business and life insurance business too. If you do not know why this is going to create annuity opportunities, I need you to call me or email me ASAP, okay? Because you're missing out. So, who pays for long-term care? Well, you can go with Medicare. It pays for only medically necessary skilled nursing facility or home care services. Emphasis on the part medically necessary. The max benefit paid is only for 100 days. You can also go with Medi-Cal or Medicaid. Here in California, it's called Medi-Cal. Nationwide, it's called Medicaid. This pays for certain health services and nursing home care for people with low incomes and very limited assets. So this could mean you'd have assets you'd have to spend down or sell off in order to qualify for Medi-Cal or Medicaid. Long-term care policy, of course. It provides for care in your nursing home, residential care facility, or home care. And lastly, you can self-fund and use your own personal assets and income to pay for long-term care. So you ask your client, do you have enough savings to cover your long-term care costs? Would you have to spend down assets to make up for any shortfall? How would you feel about spending down your assets to qualify for Medi-Cal or Medicaid? Or flat out just ask them, do you own a long-term care policy? I've heard plenty of cases where the agent didn't ask for the client because they didn't want to overwhelm the clients. I know the old adage, once you make the sale, just shut up and don't say anything else. You don't want to talk yourself out of the sale. You get so excited. But what happens is if you don't ask your client, they will come back and one day be upset that you never presented the opportunity and let them make the decision. So just ask, do you own a long-term care policy? Do you have enough in savings? How would you feel about spending your money? Just ask questions. I would recommend you ask the question early in the discovery phase, not at the very end when you close the sale. Ask them early when you're doing your probing and fact-finding about assets and how they plan on paying for any long-term care costs. So why not just go with traditional long-term care? Well, what's happening is that with standalone traditional long-term care, it's expensive, costs keep increasing, premiums are not locked in, underwriting, it's become extremely difficult to qualify for traditional standalone long-term care. And the last one is that you may never use the benefit. You pay the policy, you actually one day literally get hit by the bus, and you never use your long-term care, so you just paid into a policy that you never actually got to enjoy the benefit from. So the alternative is to combine a life insurance policy with a long-term care rider. This is actually, like I said, this is a very easy conversation. This is not rocket science. All it does, it turns your death benefit pool into an actual combined benefit pool for your death benefit and for your long-term care benefits. The money that you pull for your long-term care expenses would draw down from the death benefit dollar for dollar. So this ensures that your client will always receive a benefit by way of a death benefit or by way of long-term care. But either way, your client will absolutely 100% use the life insurance policy with the LTC Rider one way or another. As far as explaining it, it's very easy. You pay your premiums just like your normal life insurance policy, but your premiums are now funding the life insurance and a long-term care. It's a combined benefit pool. So if you have $500,000 of life insurance, you have $500,000 to dip into should their long-term care need arise. So this goes to the monthly LTC. So you would draw down for your max monthly benefit for your long-term care. And the benefit is then any portion that is not used by the long-term care expenses would go to the beneficiaries as a death benefit. So it's a very simple, easy concept to explain. It's not, like I said, it's not rocket science. So how do you qualify for the long-term care benefit? It's simple. Yeah, it's unable to perform 2 out of the 6 activities of daily living or ADLs, which is similar to just standalone long-term care, or if you need substantial supervision because of cognitive impairment. The 6 ADLs are bathing, dressing, eating, continence, transferring, and toileting. A very easy way to remember this is just think of what you do every single morning when you wake up. You go to the restroom, you take a shower, you eat, you get yourself ready. So all those things you do every morning are your activities of daily living. And of course, if you demonstrate any severe cognitive impairment that requires professional care, for example, Alzheimer's disease or dementia, you have an elimination period, which does vary by carrier, and it only needs to be satisfied once. Elimination period is basically the time frame from when you go on claim to the time benefits are paid, and it can be anywhere from 0 days to 30 days to about 90 days or 100 days. It varies, and we can go over that with the different carriers as you present the case. And you have a choice of setting, skilled, intermediate, or custodial care. You also have the choice of at-home care in a residential care facility, nursing facility, or adult daycare center. Now, there are 2 ways for you to receive your LTC benefit. There's reimbursement, and there's indemnity. With reimbursement, it never pays more than the qualifying long-term care expense. So you have a facility bill for, let's say, $5,000. you will get a check for specifically $5,000, no more. With Indemnity, it pays the maximum benefit allowed regardless of LTC expense. So let's say perhaps your monthly benefit is a maximum of $8,000. You have that facility bill of $5,000, but you want to take an extra $1,000 or $2 to help reimburse family members for just for driving you around, or for taking care of you, or for reimbursing them for their expenses, whatever the case may be. Or maybe, you know, after all their hard work and helping you out, you want to send them on a trip to Disneyland. So you can use that. No receipts are required. It's just up to you how much you want to send. You want to pull out from your long-term care benefit. So then that is the difference right there with reimbursement as well. So with reimbursement, obviously you're going to need bills and receipts, and only those specific receipts will be reimbursed. With Indemnity, you don't need to justify the bills or receipts. You just ask for how much money. Only covered costs with reimbursement will be paid, which makes them the benefit. So with reimbursement, I know a lot of people aren't too crazy about it because it sounds so constricting. However, it does help keep the cost lower for the long-term care rider, and it also helps extend the benefit, because if you're only using the money for medical situations, then you're not going to, there's not a tendency of overspending or drawing down that money much faster, which is where Indemnity, it gives you that flexibility to take a little extra if you want. You don't have to take the maximum. You can take anywhere from the minimum, you know, to what you need, to the maximum. It doesn't matter. However, of course, that means that also you could spend that benefit a lot faster. So the benefits of LTC riders: it is easier to qualify for long-term care benefits. The rider premium rates are guaranteed not to increase. They're added onto your life insurance policy. Like I said at the beginning, that's why Dad wanted the two young girls to have, the brother and sister, to have the long-term care in their 20s, because it was a fixed rate for a healthy, 20-something-year-old. It is generally less expensive than traditional long-term care, which I've been doing a lot of long-term care illustrations, and I mean, these prices are just, it's insane how much long-term care costs. I was trying to do a comparison for a client, and they bought their long-term care policy just 3-4 years ago, and just in these last 3-4 years, prices have gone up so much there's nothing I could do for them. I had to advise them to just keep their current LTC policy. And the best part, of course, is that benefit will be used no matter what with a long-term care rider, whether it's as a death benefit or should you draw down from it for a long-term care experience. This part is great, retirement planning with the LTC rider. I want you guys to check this out. The LTC rider, if you add that, imagine adding that to an index UL or some sort of cash accumulation product. You will have cash accumulating with compounding interest. This will create tax-free, non-reportable income during your retirement. You just became your own bank with your life insurance policy, okay? Next, you're injured and experience a long-term care event, no problem. You start accessing that monthly death benefit, that monthly benefit, which draws down dollar for dollar from the death benefit. And lastly, of course, if you were to pass away, the unused portion of your death benefit would be passed on to your beneficiaries. That is the Swiss Army knife of life insurance policies. These are the conversations you should all be having with your clients. You're not just an insurance agent, you are their trusted advisor and friend who is thinking of all their lives possible what-ifs. Let's take a look at a case study. Female, age 55, she needs life insurance. She, of course, wants long-term care coverage. She has a substantial 401k. She also has other investments. And what she wants to do is make sure she protects her assets against any potential long-term care needs. So we designed a universal life policy. It's a 10-pay, so she's not going to be paying premiums when she's 70 years old. She's 55. She'll be done paying premiums by the time She's about to retire. 10 annual premiums of $14,871. This purchases her a $750,000 death benefit / LTC benefit pool that she can dip into. Should there be a long-term care need, the benefits may be accelerated, and we design it with a 2% monthly benefit, which means she can receive up to $15,000 per month for the next 50 months, should there be a long-term care need. If not, any portion that is not used will be paid to her beneficiaries as a death benefit. It's a very simple conversation to have. There's nothing too complex about it. You pay your normal life insurance premiums, and that creates your benefit pool. If you have a long-term care need, you access it dollar for dollar. If you don't use it, it still works as a regular life insurance policy and pays their death benefit to beneficiaries. Very simple, very easy. The combination of universal life insurance and the LTC rider offers a cost-efficient, convenient way to help you plan for the future. I want you all to remember that if you haven't allocated any money to long-term care, you have essentially allocated all of your money to long-term care. I want to thank you all very much for attending our webinar today. It's short and sweet, but like I said, it's a very easy conversation to have. Please call me, email me. If you have a client in mind, I can run some quotes for you. And I also want to talk about the way that we have now to get that LTC rider for free through one of our carriers. I will be sending a copy of the video presentation as well. And we have a cost of long-term cost of long-term care if you want to use that to show your clients some of those stats. And then we also have the LTC medical fact finder to send out to you. We can customize these pieces for you. We can brand them with your company logo. We don't need to market ourselves. Thank you very much. If you have any questions, please call me or email me. My phone number is 805-222-6046. My email, Jesse@BackNine INS. Thank you very much.